Travis Perkins has produced the sort of result that can make a weak market look deceptively healthy. Its shares jumped as much as 18%, even though revenue fell 1.8% to £2.26 billion. Adjusted operating profit rose 6.3% to £67 million, while like-for-like sales declined 1.2%. The immediate market reading was that the turnaround is beginning to work. Profit exceeded the roughly $60 million consensus, and brokers highlighted stronger balance sheet, but this was not a broad recovery in construction demand. General merchanting volumes fell 3.9%, while Toolstation UK grew 2.6%, and Toolstation Benelux declined 6.1%. The mechanism is important. Travis Perkins improved profitability by passing through supplier price inflation more effectively, selling a more favorable mix of products, improving procurement, and controlling costs. That is operational self-help. The company is earning more from each unit sold, even while selling fewer units. There is evidence that this is more than cosmetic. Adjusted operating profit excluding property profits was stable at £62 million, and the group moved from £103 million of net debt before leases a year ago to £55 million of net cash. That improvement came through working capital discipline, capital allocation, and property management. It gives Travis Perkins more room to invest before the construction market recovers. But the counter-argument is substantial. A dividend cut from 4.5p to 4p is a reminder that higher earnings have not translated into unlimited distributable cash. The underlying operating profit was flat once property profits were excluded, and the company says UK construction activity remained depressed. Even the more optimistic broker view described only early signs of a turnaround. Peel Hunt still pointed to weak volumes, cost pressures, and the uncertainty around price inflation, particularly for oil-derived products. That distinction matters for investors. If margins are rising because the business can permanently improve pricing, mix, and efficiency, Travis Perkins may be rebuilding its earnings power ahead of the cycle. If margins are rising mainly because prices are being passed through while customers buy less, the result is more fragile. Inflation can obscure demand weakness for a while, but it cannot replace volume growth indefinitely. Management expects second-half market conditions to be comparable with the first half, and therefore expects a similar trading performance. That is not the language of a construction boom. It is a useful test. Can Travis Perkins hold its improved margin while general merchant volumes remain soft? And can those volumes eventually turn upwards without giving back the pricing gains? For holders, the 16 to 18% share price reaction should not be treated as proof that the cycle has turned. The stronger conclusion is narrower. Management has shown it can protect profitability in difficult conditions and repair the balance sheet. For watchers, the question is whether that self-help is already fully reflected in the price. The next results should reveal whether this is the early phase of a durable turnaround or simply a trough being made to look better by prices, mix, and cost control. What remains unknown is when genuine construction demand will return, and whether Travis Perkins can keep its margin gains when it does.